Hello class, this lecture is on Chapter 7, Accounting for Receivables. And in our learning objective 1, we're going to take a look at sales on credit and describe the accounts receivable process. This is going to be similar to what we've seen before with a customer coming to us and saying, hey, I'd like to go ahead and make this purchase, but I can't pay today. Would you go ahead and allow me to give you the cash in 30 days, 60 days, 90 days, to which we say no problem. The example here is we have two customers, one CompuStore coming and saying, I'd like to make a purchase for $950, but I'll pay you later. We say that's okay, and we record the $950 revenue as our credit immediately, and then we debit accounts receivable by $950. We also would take into account our cost of goods sold, which is not on this slide, but is still important to keep in the back of our mind that that's going on as well. The second transaction we have here is from another customer, RDA, that is coming later from a previous transaction that we had with them and saying, hey, I'd like to pay $720 on the amount that I still owe you. So we debit cash by $720 and credit accounts receivable by $720. With respect to the CompuStore sale, we can imagine at some point in the future CompuStore likewise is going to go ahead and pay the amount that they owe us, so we would in the future anticipate seeing $950 in cash as a debit, or as well as $950 as the credit for the accounts receivable, or broken up over that 30 days, 60 days, 90 days that we have extended them. Now, similar to just coming in and saying, hey, can I open up a tab? We may also formalize that with our customers by having a store credit card with them. This is similar to like a Macy's card or something like that, to where we're still going to hold the accounts receivable. So they're going to come in, make a transaction. We're just going to swipe the store card to where we're going to make the sale here $1,000. We'll record that as revenue. We'll debit accounts receivable by the $1,000. The difference here is we've agreed to a term of interest. So over the span of this time, we've got 1.5% as interest earned, but not yet paid on the store credit card. So we would still record an additional revenue here for the interest revenue as our credit of $15, and that would increase our accounts receivable. So we debit accounts receivable by an additional $15. Now the store credit card is different than a bank card, which might be something like a Visa or a MasterCard, because those have a payment processor in place. So the payment processor, the Visa or MasterCard, will step in place for the customer and provide cash, but take a fee associated with that. So we've got here a sale of $100. The customer used their bank card, Visa or MasterCard. We're still going to record a sale for revenue of $100, but the amount of cash that we're able to receive is only going to be here with a 4% fee. We're going to receive 96% of the amount of that sale in cash, so $96 is what we debit in cash. And then the $4 that the payment processor is keeping would get listed as a bank card expense or a credit card expense here. So this is also optimistic in terms of the customers always paying. We may also have a situation where the customer is not able to pay. So they'll call up and say, hey, I can't pay. One method that you can think about might be a direct write-off, to where we're always going to be optimistic. But when the customer does call and say, hey, I know you opened a tab for me, but I'm not actually going to be able to pay that amount. So an example might be we previously recorded a sale for $520. To where we debited accounts receivable and then had our sales listed. The customer called and said, hey, I can't actually pay after all. So what we would do if we were using a direct write-off method is we'd book an expense immediately as a debit, and we'd credit the accounts receivable back off. The problem with this method for most types of GAAP accounting is going to be that it doesn't do well with the matching. So the expense recognition principle is going to require us to report the same time as our sale, if we reasonably know. And here we're going to, because we may not know who's going to call and say, I can't make that payment. But because we've been in business and interacting with customers, history will tell us that somebody's going to call. So we may not know who's going to list the bad debt expense for us, but we know somebody's going to. So we need to find some way to accelerate that information and get that to our customers in that accounting reporting. So what we're going to use for that is something called an allowance method. So it's going to have two advantages. One, it's going to record estimated bad debt expenses in the period. And we're also going to report the account receivable on the balance sheet as the estimated amount of cash to be collected. So we're essentially going to have a net amount that's going to get listed immediately. This should make our accounting information accelerated in terms of providing that to our external stakeholders. But let's go ahead and take a look at how that's going to work. So initially, when we know that we don't know who's not going to pay, but we know somebody's not going to pay, what we can do is record that bad debt experience, and then we're going to record something called a contra asset here for an allowance for doubtful accounts. So we're going to have accounts receivable as a gross amount that we're going to list. But we're also going to have an allowance for doubtful accounts that we don't know who you are, but we know somebody's not going to pay. Here, we've got $1,500 is what we've estimated of that would be uncollectible. So the net amount we would record is going to be $18,500, and that we would take that bad debt expense immediately to lower our income and get that information into our income statement. And then we've got the net amount that's into our balance sheet as well. So it's providing more accurate information in terms of an income statement and a balance sheet faster to the shareholders and external stakeholders. So the way that's going to present is we're going to have the net amount that's going to listed there of $18,500. And then we're going to also provide that calculation. We might provide it as a note, we might provide it as a parenthetical, but in some way we're going to tell our shareholders, one, as far as net assets, we're going to have $18,500 for accounts receivable, and that two, we're calculating that by a gross amount of $20,000 and subtracting the amount we think will be uncollectible. So once we do get that call from the customer saying you didn't know who wasn't going to pay, guess what, it's me that's not going to pay, then what we'll do here is we will reduce the total aggregate accounts receivable by crediting accounts receivable by the amount where they're not going to pay. But the debit, instead of going to a bad debt expense, because we've already taken that, would debit allowance for doubtful account. So this is going to leave our net balance amount unchanged and have no income statement effect here. So we're going to lower the gross and that contra account, leaving the net unchanged. We can go ahead and look at a table here that's going to help illustrate what that looks like. To where previously we've had $20,000 as the gross amount minus $1,500 for the allowance would get us $18,500 for the net. Once we subtract $520 from both, we'd have $19,480 for the gross amount of accounts receivable still on our balance sheet, minus $980, which is what's left in that allowance for doubtful account, which is going to leave us that same $18,500 as the net amount, which makes sense. The only thing that's changing is before we knew $1,500 worth of write-offs were coming, we just didn't know from whom. Now we know $520 of that $1,500 where it's coming from, if our estimates are correct. So the customer might also tell us, hey, you didn't know who wasn't going to pay. Guess what? It's me that's not going to pay. And then if they do have a way to pay later, go ahead and still provide that cash. So if for some reason in this example Kent were to still pay after telling us that they were not able to pay, what we would do is reverse the write-off. So we would debit accounts receivable back and then credit the allowance for doubtful account back. So going from the column that was on the right-hand side back to the column that's on the left-hand side, to where we would have a net amount, or excuse me, have a full amount of $20,000 minus $1,500 again. And then we would debit cash by the $520 and then credit our accounts receivable for the $520. So essentially we'd unwind it and then perform the journal entry in which we receive the cash the same as we ordinarily would do. Now, in order to get this estimate, you may ask the question, where did that $1,500 come from? How do you calculate that? We're going to have two different ways to where we can estimate our bad debt expenses. One's going to be called the percent of sales method, which is going to be fairly straightforward in terms of the calculation, but maybe not as accurate. And then we've got an accounts receivable method. It's going to be a little more cumbersome, especially if we get into the aging accounts for the calculation, but might be a little bit more accurate in terms of what's still outstanding. So let's look at the percent of sales method first. What we're going to do is we're going to use our history of being in business to come up with a percentage of every sale that we think will end up as a bad debt. So in other words, if we record $1 million in a period of sales, we might say that, hey, 1% of every sale we make ends up being a bad debt expense. We don't know who's not going to give us that 1%, but that's just what happens. Eventually somebody will say, hey, we're not able to pay that for those sales on credit, that is. So if we had $1 million for sales that we had on credit, 1% is our bad debt expense. We take 1 million times 1% to get us 10,000. So we would take $10,000 as the bad debt expense immediately in that period. Here, kind of looking through this calculation, similarly, 400,000 in sales, we estimate 0.6% are going to be uncollectible. So we take 400,000, multiply by 0.6% to get 2,400. So we would debit 2,400 as the bad debt expense, and then we would credit that allowance for doubtful account by 2,400. The percent of receivables method is going to be the other way to estimate it. And what we're going to do here is we're going to look at everything that's owed to us and say what percent of what's owed to us do we think we're not going to get. And that we're going to find out how much we had in that allowance for doubtful account left over previously. How much of it do we think we're not going to get? And then we're going to take a bad debt expense to catch up to it. So if we think that $10,000 of what's owed to us is not going to get paid, we may not know who's not going to pay us, but we know somebody's not going to pay us. And we currently have only a $1,000 allowance for bad debt on our balance sheet. What we can do is take that difference of $9,000 as a bad debt expense to increase that allowance for doubtful account by that amount. So we'd move it from $1,000 to $10,000 by taking a $9,000 bad debt expense. And you can see the example here to where we had $50,000 in accounts receivable. We only had $200 in the credit balance, and we thought 5% of those receivables would be uncollectible. So we'd multiply $50,000 by the 5% to get $2,500 for the amount we think we're not going to be able to collect on. And then we would take a $2,300 bad debt expense to move our allowance for doubtful account from $200 to $2,500. So it's that difference that we're taking as the bad debt expense. Aging of accounts receivables is going to be the same concept as that allowance method for percent of receivables. The only difference is we're going to look specifically at how many days those are owed to us. So in the previous example, we said 5% of what was owed we didn't think we would be able to collect on. Here, we might be a little bit more precise and say, well, if it's still current, if it's due within 30 days of being due, maybe only 2% of those are going to be uncollectible. If it just becomes past due, that's when the 5% kicks in. If we're not able to collect it after 30 days, then it's going to start increasing in terms of the unlikeliness to receive payment. So maybe up to 60 days, it'd be 10%, maybe up to 90 days, 25%. And then if you're over 90 days past due, it's almost a coin flip, say 40% in terms of whether we're actually going to receive funds. So we're going to break out the amount of that total 50,000 accounts receivable in terms of how much it's how long it's been since the statement's been issued, and to see what portion of it's past due, and then do an individual percent uncollected for each of those amounts. And then we'll get the amount we think should be our allowance for doubtful account amount for each of those ages, and then add them together. So, and then same as for the percent of receivables, once we get our allowance for doubtful account using the agent method, we would look at what the previous balance of that was and take the bad debt expense to get that difference, to get it up to. The only difference between the percent of receivables and the aging of receivables is how precise we are in terms of looking at how long that accounts receivable has been outstanding in terms of the percentage. The estimation for bad debts, though, using these methods are going to be a balance sheet focus. So we're looking at how much is currently owed to us and what is the percent that's going to be unpaid. The percent of sales is going to take an income statement focus in contrast, where we're literally just taking every sale and then we're going to take the bad debt expense from that simple calculation. And then whatever that makes our allowance for doubtful account, it is what it is. If we are way off, hopefully over time we kind of notice that and we might change what that rate's going to be for future bad debt expenses. But we're just going to map that directly into the increase in allowance for doubtful accounts that we have. So we might, if we have an accounts receivable that we think is not going to be paid, we may reach out to the customer and say, hey, can we formalize this in some way and put a contract in place as a note receivable? So similar to what we saw with the store credit card where interest was being earned, we might do something similar to where we say, hey, you owe us $1,000. It's been 90 days. I know you don't want this to become an uncollectible account. How about if we make an agreement where we'll give you another 90 days, but we're going to need 12% on this over that span to where we would. We might do this initially as well, to where when we're making our initial sale. Here in this example, if we had $1,000 that we had for a sale, we might receive the note at the time of the sale and debit note receivable by the 1,000 instead of account receivable, and then still credit the sale. So it comes into play in both of those two scenarios. The note receivable is going to also carry that interest. So we'll here in the 12% is only going to be 12 months. So we're going to use kind of the banker's rule here, to where we mentioned in previous classes that we might have 365 days, we might have 360 days in terms of the number of days in a year. Here we're going to use 360 days for the number of days in a year just because it makes it kind of even out. It doesn't matter if we're talking about first quarter or fourth quarter. Both of them we're going to split evenly and say 90 days in each quarter. So for the amount of interest we're going to have, we're going to take that 12% times 90 days divided by the 360. So we're going to have 3% times our 1,000 to get $30 of interest for the computation. And then once it's due, so in this example, we're going to have both the principal and the interest due on the maturity date. Here we've got $600 with a 15% 60-day note that's due on December 4th. On December 4th, we would get the $615 in cash, and that's going to be broken up by the notes receivable that we previously had debited at the time of the sale. Here we're going to credit that $600 back off, and then we had interest revenue that we might have earned over that span of time of $15. But here we're going to credit that. We're going to credit the revenue as we earn it over the span of time, rather. But that's going to be debited by the additional $15 in cash along with the credit to the notes receivable. So here we've got $615 for total cash, and that's $600 crediting notes receivable to get it off our balance sheet, and then $15 in the interest revenue as it's earned over that span of time. And then once we have an end of period where we might have earned the $15, but instead of receiving cash for it, if we haven't received cash for it at that point, we may list it as a separate receivable, where the note was listed as a note receivable. The interest earned, we're still going to record that earnings, the interest revenue, but we may offset that credit with a debit of interest receivable. So we'd have a note receivable of the amount of the note, and then an interest receivable for that earned over that span of time but not collected. And then once it is collected, then we would credit that interest receivable off. So in this example, $3,060 is the total cash received as a debit. $3,000 is going to be credited to note receivable, so getting that off our balance sheet. $15 is going to be to the interest receivable to get that off the balance sheet, and then $45 is the interest revenue earned over that span of time. So this would be our transaction for the collection at maturity. And that's going to conclude chapter